Hey everyone, welcome back to Corporate Decoder. Today, Abacus Global Management Incorporated just filed a Form 8K reporting and amendment to their credit agreement, and I am seeing a significant expansion of their debt. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company has taken on a large new loan, and we need to understand what this means for their financial health. Alright, let's dive into this Form 8K filing from Abacus Global Management Incorporated. This is a current report, meaning something important and usually time sensitive has happened. The key date here is the 29th of June 2026. That is when the main event in this filing occurred. The company we're looking at is Abacus Global Management Incorporated. They are in the financial sector. They have common stock trading on the New York Stock Exchange, and it is listed under the ticker symbol ABX. They also have some debt instruments like these 9.875% fixed rate senior notes due 2028 trading under ABXL. What is really important in this filing is item 1.01, which deals with entering into a material definitive agreement. This usually means a significant contract or deal has been signed. On the 29th of June 2026, Abacus Global Management Incorporated, which we'll call the company, made an amendment to a credit agreement. This is like updating a loan contract. The original loan agreement was back in December 2024. Here is the big news. Lenders have agreed to provide an additional $75 million in loans. These are called incremental term loans. When you add this new money to what they already owed from before, the total amount the company owes under this new amended credit agreement is now a whopping $225 million. That is a significant increase in their debt load. Think about it this way. If they already had $150 million borrowed, adding another $75 million brings their total debt from this specific agreement to $225 million. That is a 50% increase in the amount borrowed under this agreement. The good news is that apart from the extra money borrowed, most of the other important terms of the loan, like interest rates and repayment schedules, haven't changed dramatically. All the money borrowed under this agreement, including any future loans they might take out under a delayed draw option, is due to be paid back by the 10th of December 2030. They have to make regular payments every 3 months. These payments are typically 1% of the original loan amount for the initial loans and the new incremental loans, plus some extra payments based on how well the company is doing financially, measured by something called Consolidated Adjusted Earnings Before Interest, Taxes, Depreciation, and Amortization, or EBITDA. The remaining balance is due on the final date. The interest rate is tied to SOFR, which is a benchmark interest rate. It is currently SOFR plus a fixed rate of 5.25% per year. There is a chance for this rate to go down to 5.00% if the company meets certain financial goals specifically related to their EBITDA and how much debt they have compared to their earnings, which is called the total leverage ratio. If they have money committed to them under the delayed draw facility that they haven't actually borrowed yet, they have to pay a fee on that unused amount. They can pay back this new $75 million loan early, as long as they pay at least $1 million at a time. However, if they pay it back within the first year of taking the loan, they'll have to pay an extra 1% of the amount they're prepaying as a penalty. So as of the 29th of June 2026, right before this amendment, the company already had $148,125,000 in debt outstanding under this credit agreement. After the amendment with the new $75 million, their total outstanding debt under this agreement is now $225 million. This is roughly a 51% increase in their debt from this specific facility. This explanation is just a summary. For all the nitty-gritty details, you'd need to read the full amendment document, which is attached as an exhibit to this filing. Now, let's move on to item 5.02, which covers changes in directors or officers. On the 30th of June 2026, Sean McNeely decided to step down as a director of the company. This is due to his plans for retirement. The company wants to make it clear that Mr. McNeely's departure isn't because of any fights or disagreements about how the company is run. It is purely his decision to retire. He is not completely leaving the company. He'll stay on as an advisor to help smooth out the transition for a while. As part of his retirement, he'll also be stepping down from any leadership roles he holds at any of the company's other businesses by the end of 2026. Finally, item 9.01 lists the financial statements and exhibits that are part of this report. We've already talked about Exhibit 10.1, which is the actual first amendment to the credit agreement. This is the document that details the new $75 million loan. Exhibit 104 is the interactive data file for the cover page, which is standard for these filings. And here at the end, we have the signature section. This report was officially signed on the 2nd of July 2026. The report is signed by Jay Jackson, who is the Chief Executive Officer of Abacus Global Management, Incorporated. Now let's talk about what this all means. Abacus Global Management, Incorporated is taking on a lot more debt. They've increased their borrowing under this credit agreement by about 51%. Going from roughly $148 million to $225 million. This is a pretty substantial borrowing, especially for a company that is not a giant. This could mean a few things. On one hand, they might be using this money to fund growth opportunities, maybe acquisitions or new projects. That is the optimistic view. On the other hand, increasing debt significantly always comes with higher risk. They have to make sure they can comfortably handle those larger quarterly payments and the full repayment in 2030. The interest rate, while not astronomically high, is still a fixed cost that will eat into their profits. If their business doesn't perform as expected, these new debt payments could become a real burden. We also saw a director, Sean McNeely, resign due to retirement. While the company stated it is not due to any disagreements, leadership changes can sometimes signal shifts within a company, even if it is just a planned succession. Looking at the broader context, there have been recent positive headlines about Abacus Global Management, Incorporated, with mentions of it being an overlooked growth story in March 2026 and a transfer of its stock listing to the New York Stock Exchange with a new ticker symbol, ABX, in late 2025. This suggests the company has been trying to raise its profile and potentially attract more investors. This new debt could be a move to accelerate that growth or support the business in ways that allow it to continue that positive trajectory. My main concern here is the sheer increase in debt. For a company of their size, a jump approaching $77 million in debt from a single agreement needs careful watching. Investors will want to see exactly how this new capital is being deployed, and if it is generating returns that justify the added financial risk. The key will be whether the company's earnings can keep pace with its increased debt obligations. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Join our Discord in the description.